Welcome to Learning Gate. In this video, we will learn about 9 financial rules of thumb to know about a company Moat. If you want to invest, you must know how to identify a Moat. What is your favorite among all these metrics? Comment below your favorite one. And I will also share my favorite one and Warren Buffett favorite. Here are 9 financial rules of thumb that Warren Buffett uses to tell if a company has won. Number 1. Gross margin. You can find it in income statement. The formula is gross profit divided by revenue. If it consistently above 40%, it have Moat. If under 40% and volatile, there will be no Moat. Warren Buffett's logic about it. A consistently high gross margin signals that the company is not competing exclusively on price. A high gross margin also provides ample gross profit to pay expenses and leaves money for shareholders. Number 2. Sales, general and administrative expenses. You can find it in income statement. The formula is sales, general and administrative expenses divided by gross profit. If it consistently under 30%, there will be Moat. If it is over 80% and volatile, there will be no Moat. Warren Buffett's logic. Wide Moat companies don't need to spend a lot on overhead to operate. No Moat businesses do. Buffett look for companies that consistently spend under 30% of their gross profit on sales, general and administrative expenses. Number 3. Depreciation expense. You can find it in income statement and cash flow statement. The formula is depreciation divided by gross profit. If consistently under 10%, it have Moat. If high than 10% and volatile, there will be no Moat. Buffett's logic. If depreciation is consistently less than 10% of gross profit, it's a sign the company does not need a lot of capital expenditure is it to maintain its competitive advantage and has a Moat. Number 4. Interest expense. Find it in income statement. The formula is interest expense divided by operating income. If consistently under 15%, there will be competitive advantage. If over 50% and volatile, there will be no Moat. Buffett's logic. Great businesses have such wonderful economics that they don't need to rely on debt. While this number varies greatly from industry to industry, it's a great sign if a company consistently spends less than 15% of its operating income on interest. Number 5. Income tax expenses. You can find it in income statement. The formula is income tax paid divided by pre-tax income. If it consistently pays the full amount, there will be Moat. Negative or erratic can consider with no Moat. Buffett's logic. Wide Moat businesses make so much money that they are consistently forced to pay their full shares of taxes. Companies that consistently have negative or an erratic income tax bill are not as likely to have a durable Moat. Number 6. Profit margin, net margin. You can find it in income statement. The formula is net income divided by revenue. If it consistently above 20%, it have Moat. If it below 10% negative and volatile, there will be no competitive advantage. Buffett's logic. Companies that consistently convert 20% of their revenue into net income likely have a Moat. This number is under 10% negative or volatile. It's an indication that competition is fierce. There is plenty of nuance between 10% and 20%. Number 7. Capital expenditure. Find it in income statement and cash flow statement. Formula is capital expenditures divided by net income. If it consistently under 25%, there will be Moat. If it consistently above 75%, it have no Moat. Capital expenditure eat into profits. Companies that don't have to spend big on capex have more money to reward shareholders. Important. Capital expenditure can vary greatly from year to year. Averaging the result over 10 plus year is the best. Number 8. Total liabilities to adjusted shareholder equity. You can find it in balance sheet. Formula is total liabilities divided by shareholder equity. Below 0.8 have competitive advantage. Over 2 have no Moat. Buffett's logic. Wide Moat businesses finance themselves with profit, not debt. However, stock buyback can throw off this equation. Just for this by adding back any treasury stock to the shareholder equity number. Number 9. Return on shareholders equity. You can find it in balance sheet and income statement. The formula is net income divided by shareholder equity. If it consistently above 15%, there will be Moat. Below 10% negative or volatile have no Moat. Its logic. Return on equity shows how effectively management is reinvesting its profit. A number consistently over 15% indicate that the business has a moat. 10% negative or volatile indicate that the business is struggling with competition. Important notes. Number 1. These rules of thumb are only useful when a company is fully optimized for profits, page 4 and 5. They work in some cases in page 3 and 6, but don't work at all in page 1 and 2. Number 2. Consistency is key. The real test is if a company generates good number over multiple years in various economic cycles. Number 3. There are plenty of exceptions and nuances to these rules. Many of Buffett's largest holdings do not pass every rule of thumb. That's because investing has tons of nuance. Still, rules of thumb are very helpful. 3. Number 1. Gross margin will be more than 40%. Number 2. Sales, general and administrative expenses will be less than 30%. Number 3. Depreciation less than 10%. Number 4. Interest expense less than 15%. Number 5. Income tax full 21%. Number 6. Profit margin more than 20%. Number 7. Capital expenditure less than 25%. Number 8. Debt to adjusted equity less than 0.8. Number 9. Return on equity more than 15%. Number 8 and 9 are my favorites, and number 9 is Warren Buffett's favorite. Thanks for watching. See you soon, guys.